Good morning, everybody. My name is Sharon Rich. I am the Senior Trust Advisor with AGID. Welcome to AGID's webinar. We are starting our monthly webinars with today's presentation, and we're going to be having a monthly webinars going forward on the second Wednesday of each month at 11 o'clock. So please look out for our messages regarding those upcoming webinars. Today we have a program on reverse mortgages, and it is certified for continuing ed for professional guardians and attorneys, and also certified senior advisors. So everybody will be getting a certificate of attendance within about a week after the presentation. And if you're the guardians, we report for you with your OPPG number. And if you self-report, just take that certificate and do your own self-reporting. I am very excited today to introduce our speaker, Tim Linger. Let me get Tim's bio up here, but he has been in the reverse mortgage industry for like 30 years and does quite a bit of speaking on the subject. So I ask you to go ahead and put your questions into our chat, and we will kind of go through those as the presentation is going along. We have many people on the webinar today, but we'll try to answer your questions as we go along and be finished up by 12 o'clock. So again, thank you for joining and happy Valentine's Day to everybody. And Tim, please go ahead and take it away and share your presentation.
All right. Thank you very much, Sharon and Kate. So once again, my name is Tim Linger, and I'm a certified reverse mortgage professional. I've been in the industry for 24 years, but we can round it up to 30. That's fine. But CRMP, I'm very proud of that. There's 175 of us in the entire nation. What that means is we're the experts of experts. In order to get a CRMP designation, you have to be really, really, really good at the industry. And I've been doing this for so long, in fact, almost more than anybody in the country. And I've gotten really good. So I can pat myself on the back. It's something I'm very proud of. I'm also a certified senior advisor. Let's jump into this. And the way I like to do my presentations is I like to have a lot of Q&A. So if you have a question and you type it into the chat, if you prefer to say it verbally, I'm assuming you can raise your hand, we can unmute you. But I'd like to get some feedback from the people here. If you love reverses, throw me a curveball, throw me a difficult question, maybe something that's negative. And if you don't like reverse mortgages, then let's talk about that too, because you're not going to trip me up. When people understand the FHA version of the reverse mortgage, they come to love the program, not like it. They love it. A lot of misconceptions out there. The biggest ones are the bank's going to eventually take my house. If I do a reverse, I lose ownership. I lose title to the property. I won't be able to leave it to my children. All that's false. Closing costs are high. Well, they're higher than traditional financing, but there's no mortgage payments. So what do you call expensive? We'll get into all that, but let's jump into this right this minute. And like I said, I love questions, so feel free to ask as many as you want. And this is not working. Let's see here. There we go. All right, so what the heck is a HECM? Home equity conversion mortgage. That's the legal name of FHA's reverse mortgage. HECM, home equity conversion mortgage. So let's go way back to 1961 when the very first reverse mortgage was written in America. It was something that was unheard of. And the story goes that little old lady went to her banker and said, my husband just died and I need money and I don't have any children. Will you buy my house? And would you let me live there? Which is a totally off the wall concept, but it's a small savings and loan in Portland, Maine. And Nelson Hayes discussed it with Nellie Young, and they worked out a deal where she could stay in the house for the rest of her life. And then when she died, the bank would take the house. Now, there's the very first reverse mortgage, and perhaps that is where the current misconception comes where the bank's going to take the house. So, what is that? 60 years ago, and that rumor still persists. And perhaps in the 60s and even the 70s, maybe that was the norm. But in the 80s, when the federal government got involved, in fact, let's go back to the 60s, where a UCLA professor went to Congress and testified, and they discussed coming up with some kind of a senior citizen housing annuity. Is there any way that we can enhance Social Security? So through the 70s and into the 80s, this discussion continued, and Senator John Hines lobbied the Senate to get something passed into law. So in 1984, the American Homestead Foundation sets up some kind of a century plan, something that would allow people to have some income, perhaps for 100 years, or up to their 100th birthday or beyond. 1987, Congress passed it into law, and guess what? 1988, Ronald Reagan. In 87, Ronald Reagan passed into law. I'm sorry, 1988, Ronald Reagan passed into law, and then in 1989, the HECM was born. So this program's been around for 35 years. The FHA version of the reverse mortgage has been around for 35 years. Other types of reverse mortgages are still around, and I don't know of any that actually take the house, not even the proprietary or the private or the portfolio, whatever you want to call them. Not even those reverse mortgages will take the house. They may have equity share on a rare occasion, but as a rule of thumb, a reverse mortgage is just a loan. Is just a loan. So I'm going to focus today on the HECM. And the reason is because 98% of all reverse mortgages in the nation are written by FHA. Why? Because it's the safest kind of loan there is. It's the safest reverse mortgage, but it's also the safest kind of loan there is. This loan is sponsored by HUD. It's insured by FHA, has a fantastic reputation and satisfaction rate for those who have actually taken the plunge or for those who are in the know. Once again, people that understand the reverse mortgage come to love them. One more time, they don't like them, they love them. So please keep an open mind, open eyes, and let's begin. So a HECM is a type of reverse mortgage. It's not the only reverse mortgage. Yes, 98% of all reverses are HECMs, but it's not the only type. So the analogy is that let's look at it as a fruit. Limes would be considered sour. Grapefruits, lemons, sour. Maybe a strawberry or a pineapple or an orange are considered sweet. They're all fruits, but they're different types of fruits. So reverse mortgages, there's different types of reverse mortgages. The HECM happens to be the sweet kind. If you want to, did I miss? Yep, I skipped a slide. Okay. All right, so that's good enough. Again, feel free to ask questions. I love questions. So the Federal Trade Commission recognizes three types of reverse mortgages. The FHA, the HECM, is the best and the safest. But there's also a single purpose reverse mortgage. And it's typically not called a reverse mortgage, but FTC recognizes a single purpose loan, such as a property tax deferral, as a reverse mortgage. So think about this. Orange County, as an example, and probably most counties in Florida have this program where if you're meeting certain criterias, I believe in Orange County it's age 70, on limited income, a homeowner, and you can't afford to pay your property taxes. Orange County government, again, most governments in Florida will allow that senior to defer their property taxes for the rest of their life. Think about that. If a person can defer their property taxes for the rest of their life, that might be able to keep them in their home. Reverse mortgage is not free money. Mortgage, the definition of mortgage, a loan. So if the county defers property taxes, they're in a sense loaning the senior money, the amount of their property taxes. So if they defer their property taxes for 10 years, they would owe 10 years of property taxes. If they pass on, then those property taxes would be paid for by the sale or refinancing of that property. Then we have proprietary. I like to call them portfolio because proprietary sounds like predatory. Portfolio reverse mortgages are done usually by some kind of a lender, some kind of a financial institution. It's a private loan. I don't like to use the word private because people think it's me lending money or somebody else lending money. It's typically a corporation, a bank, a lending institution. But those are usually designed for more expensive properties, not always. But typically you think of a proprietary or a jumbo reverse as something that would be for a multi-million-dollar house. But they've come to age where now we can use them for maybe oddball properties or maybe mainstream properties that are hard to get FHA loans on, such as condos. So we use a lot of proprietary reverse mortgages for condominiums that are not approved by FHA. Is there a
Yeah,
question?
Tim, I'm going to stop you there. It looks like one person is having audio issues. Kimberly, I'm not having, I can hear you perfectly. It looks like maybe some other people are fine also. So hopefully Kimberly can figure out her audio issues. Yeah, it looks like everybody else is good. So I don't see any other questions. So go right ahead.
Hopefully, hopefully this is recording properly where she can go back and listen to the recording.
Yes.
All right. So HECM reverse mortgages or any kind of reverse mortgages by definition have no required monthly mortgage payments. And the reason I stuck the word required in there is because what the industry says is no monthly mortgage payments. And I don't like it because no means no. No means no. Optional monthly mortgage payments would be more accurate, or no required monthly mortgage payments would be more accurate. And I say it that way is because one of the objections that we get when someone says, well, I don't want a reverse mortgage because eventually I'm going to owe a lot of money and I don't want to leave my kids in debt. So the answer to that is, well, you have the choice to make a payment or not. No required monthly mortgage payments. When the lender servicer sends you a monthly statement, you have the right to pay that payment. And if you choose to make that payment, then the balance goes down like all other mortgages. And if you choose not to, then you've increased your checking account balance and you've increased your loan balance. But when you pass away, when you sell the house, when you're done with the property, the amount of money or let me just use the word passing away. When you pass away, there's nothing going with you. So in one sense, who cares what your balance is owed? Most important is if you've lived a better financial life while you're alive. Now we're going to go into the non-recourse feature in a moment because I know a question will pop up. Well, if a person owes a lot, what if they owe more than the house is worth? So we'll discuss that in a moment. So this CE class or CLU class is primarily about the FHA HECM reverse mortgage because once again, 98% of all reverse mortgages are written under the FHA program. So since reverse mortgages have such a negative reputation, I like to call it a HECM. So you would do yourself a good service that when you're talking to your clients, try to avoid the word reverse mortgage. Instead, call it a HECM or special senior financing. And the reason, once again, is that the HECM, no one knows what the heck a HECM is. Therefore, they're willing to listen. If you use the word reverse, a lot of times they'll close their ears and not hear anything after that. So this is the FHA HECM, and that's what we're going to talk about today. And we're going to dabble a little bit in the portfolio loans, but mostly the HECM. So how much is FHA willing to allow a lender to loan? It's approximately 30% for 62-year-olds and maybe as much as 50% for somebody in their upper 80s. And remember this, FHA or the lender is not buying your client's house. They're loaning money that does not require a mortgage payment. And FHA does not want to own that house. The lender does not want to own that house. They only want to lend money on a deferred interest basis and never be in a situation where the balance of that loan exceeds the value of the house. Now, mathematically and statistically speaking, if the bank is only going to lend approximately 35-40% of the home's value, as the home increases in value, right? 4% is the national average. As the home increases in value and the balance of the loan increases, there should never, ever be a time that the balance of the loan exceeds the value of the house. Once again, the house is always increasing in value. Even if it goes down over time, history shows that it always increases in value. So rarely is there a situation where the loan is upside down. But let's talk about the non-recourse feature because this is what makes the loan the safest loan in the United States. If there's ever a time that the balance of the loan does exceed the value of the house, and the borrower is done with the property. They've passed on, they've moved out permanently, they're done with the property. And this house is now upside down, it's underwater. The value of the house does not reach the amount that is owed on the loan. FHA will eat the loss. FHA's non-recourse feature kicks in and will make up the difference to the lender. So the lender doesn't lose, the senior doesn't lose, the senior's estate doesn't lose, and the senior's family doesn't lose. So let me give you a visual financial number example. Let's say someone did a reverse years ago. The house is worth $200,000. And let's say they were, well, simple math. Let's say they borrowed $100,000 on a $200,000 house. And let's say they lived a long time. And now the loan balance has gone from 100,000 to 250,000. But the home now is not worth 200,000. Now the home should be worth 400,000 or even 500,000. But let's just say we're in the middle of a housing recession, 2008, and this $200,000 house is still worth $200,000. It went up in value, but then it crashed. The balance owed is 250. The house is only worth 200,000. There's a $50,000 underwater amount. The kids have two choices, or the estate has two choices. They could say, we want the house. And FHA will give them a clear title for 95 cents on the dollar. In other words, 95 cents on the current value is $190,000. They will give them a clear title for $190,000. The difference is washed clean. If the kids don't want the house, the family, the state doesn't want the house, they could hand the keys back to FHA and say, we're done. They can clean out the house. They can take the Cadillac, maybe the Ferrari that the husband was restoring, the $500,000 in the bank accounts and the safety deposit box. Only the house is used as collateral. They can hand the keys back and walk away. There's no deficiency judgment. There's no IRS hit. There's no tax hit. There's nothing. It's a non-recourse loan. So when someone says, well, yeah, but eventually you're going to lose your house. Eventually you're going to owe more than the house is worth. Eventually, it's all false. In fact, to put it in perspective, everyone on this call, I'm sure, knows what a mortgage is, right? A mortgage, I like to say, a mortgage is a mortgage is a mortgage. We can call it a VA loan, an FHA loan, a conventional loan. We can call it a jumbo loan. We can call it anything you want to call it. But a mortgage, at the end of the day, is where a lending institution, a bank, lends someone money to, let's say, buy a house. And in exchange for this chunk of money to buy a house, the bank puts a lien against the property, right? To protect their cash, they put a lien against the property. And a person will make mortgage payments for upwards of 30 years, right? That's a mortgage. Person borrows money from a lending institution. They put a lien against the property. Now the borrower now is a homeowner. And as a homeowner, they have title to the property. And with title to the property, they pay the property taxes, they pay the homeowner's insurance, they pay the HOA, they maintain the house. It's their house. The lender just has a lien against it, right? So that's a mortgage. A mortgage is a mortgage is a mortgage. If we want to call it a HECM, if we want to call it a reverse, it's still a mortgage. A mortgage is a mortgage is a mortgage. So all the things that you know about mortgages. In other words, when you die, can you leave your house to your children? Yes, because it's a mortgage. Can you sell the house at any time? Yes, because it's a mortgage. Can you add on to the house? Can you add a pool? Can you have purple walls and pink carpet? Yes, because you own the house. Can you add somebody to title? There's some rules on that per the mortgage contract, but certainly yes. If you got married or your spouse died, is that a problem? No. In most cases, no. A mortgage is a mortgage is a mortgage. All right, there's got to be some questions. So before I move this slide, there we go. We have a question?
Tim, I was going to ask you about the interest rate. What kind of interest rate do the reverse mortgages give?
So they're competitive with traditional financing. Right now, we're in the 6% range, and most of them are adjustable rates because that's how the line of credit program works. So FHA is expecting the rate to come down. We might be about 6.5 right now, which is pretty competitive with forward mortgages.
Okay.
And you know what I say is anybody who is 62 and above that's getting ready to take out a 30-year mortgage, which would make them 92 when they pay it off, might want to look into a HECM and see if that's a good option. And the reason is because wouldn't it be nice to have an optional mortgage payment? And then come December, maybe you want to skip it because it's Christmas time, or maybe the kids need some assistance. Kids always need assistance financially, and it's nice to be able to skip a payment when you need to.
Tim, do most people not pay once they get the HECM mortgage? Do most people just not pay on the loan at all?
I love that question. I would say that 20% of the people that are considering, when I sit down with them and do a financial assessment, I'd say 20% of people tell me that they would love to make a payment, that that's one of their hot buttons. They want to make sure there's enough home value for their children. And and I would say that near zero are the number of people that actually make a payment. They tell me they will, but when I check with them years later, oh no, I don't care. I've helped my kids out now. My daughter called me and said she needed $5,000. I gave it to her. I had the money to give it to her. I gave it to her. If there's something left over for her, great. If not, it's all about me. And I agree with that.
Right. But people still have to pay their real estate taxes every year, correct? And their insurance?
They do. They have to maintain what any mortgage would require, which is property taxes, homeowners insurance, HOA, and maintaining of the house.
Right.
Yeah, we're just a mortgage that doesn't have mandatory payments. That's really the simplest way. Someone told me one time I need an elevator speech. I'm going from the first floor to the third floor. Someone asked me what I do, and my answer is, well, I do the HECM Reverse Mortgage. It's optional payments for seniors. Boom, done. Right? Because that sums it up. And we could talk about this for an hour, and we will, but that sums it up. It's a mortgage like any other mortgage, except payments are optional for those that are 62 and above. Before I move from this slide, I just want to reiterate that age has its benefits. The older a person is, meaning the less life expectancy, the more FHA is willing to allow to be lent. And I say FHA is willing to lend more. FHA doesn't lend money. FHA insures the money that's lent by a bank. So a younger person, let's say 62, the loan to value might be 33%. It also depends on the value of the house. So age has its privileges. Any other questions? All right. Apparently, I got ahead of myself on the non-recourse loan. So once again, a borrower can never owe more than the home is worth, not ever. So when is this loan due? The loan is due when the last borrower leaves the property permanently. Now, those words were carefully chosen. The loan comes due when the last borrower or borrower spouse, if you will, leaves the home permanently. So husband, wife gets married, one dies. All right, we're fine. The loan lives on. The second person now moves into a facility temporarily. Maybe they broke a hip and they need 3 months of rehab. Well, they're not permanently gone. They're temporarily gone. Or maybe they're a snowbird. They live 6 months in upstate New York, and they come down to Florida. Maybe there's a hurricane, or maybe there's COVID, and they don't make it down this year. But they're still living here, right? So it's when they leave the house permanently, then the loan comes due. And FHA gives upwards of a year to settle the house, or to settle the loan, meaning they sell the house and pay back the reverse, or they uh, refinance the house, whatever they have to do. But FHA, if you're not living in the house permanently, they want their money back, and they're giving 4 sets of 3 month increments. In other words, 3 months to make a decision. I'm going to sell the house or refinance it. They give another 3 month extension, 3 month extension, up to 12 months. If a person dies, then they're definitely not moving back into the house, which means the loan comes due, but are also given 12 months. If a person goes into a facility or chooses to move in with family, thinking they're going to move back, but 12 months later, they still haven't moved back, FHA says, well, you probably aren't coming back, so we want you to pay us back. FHA then gives another 12 months. Now we're talking 2 years. If a person is still alive, they actually have upwards of 2 years. The point of me banging on this is that there's never a fire sale. Not when a person dies or a person's alive. There's never a fire sale. the house can be sold at fair market value because almost always there's equity in the house. Rarely is there an upside down situation. It happens, but there's always equity in the house. So FHA doesn't want to force the family to have a fire sale. Sell it at fair market value, pay back the loan, keep the difference. So if they change the title, the loan could be called due. When the last remaining spouse or borrower passes away, so sometimes I'll have a husband and wife will bring in their friend, and there's three people living in the house, but the friend might be 40 years old, and mom and dad are 62 and above. Mom and dad pass away, and their friend or their son, whoever it is still living. Well, they're not part of the loan. They may be a resident in the house, but they're not part of the HECM, which means the loan still comes due. So it doesn't matter if a kid lives there. If the kid is not part of the loan, then the loan still comes due. The kid could inherit the property, but the loan still comes due, right? The title, whoever's on the title doesn't matter. What matters is who's on the mortgage. So if you fail to comply with the terms of the mortgage, such as you don't pay your property taxes, the roof leaks and you don't fix it and the house is becoming in disrepair, and FHA finds out about it, they're going to call the loan due. If you don't pay your HOA dues, if you get a county code violation, they put a lien against your house. If you violate the terms of the contract, they could call the loan due. If you don't satisfy the contract, then they could start foreclosure, like any mortgage company could. Questions?
So Tim, I do have a few questions. I apologize. My scroll was not working properly. So if we could take a minute to ask a couple of the questions. Ronald wanted to know, I'm not sure exactly what the question is, but it says clear title for 190,000 ? No mortgage. Explained. Payment disclosure from lender.
Okay. So this is the non-recourse feature. So let's digress back to that. Let's say that I'm going to use different numbers just to sort of hit home. Let's say
Tim, we are not hearing you now.
It looks like his screen is frozen as well.
Uh-oh. Tim, I don't know if you can hear me, but we are having trouble with your audio.
I think he just left. Maybe he's gonna try to re-enter.
Okay. I'm sure he will re-enter in a minute or two. I will say I've had a couple clients that have done what I always called a reverse mortgage, but I'll use the term HECM mortgage. And it's really helped them a lot, not have to, pay that monthly mortgage amount. And I've known other people personally that have actually done them. And, in some instances, it just really makes a lot of sense. And from a Medicaid standpoint, as many of you know, Aged, we deal with Medicaid. All of our clients are on some kind of Medicaid. I can tell you that the amount does not, just by having a reverse mortgage and the ability to pull money out of it, like a loan, does not disqualify you from your Medicaid benefits. If you take money and you get, a $20,000 distribution and you put it in your checking account, now it becomes cash and an asset. But if you take money and, use it right away, then you should be okay. So I see that Tim is trying to get back in here. Kate, do you see?
I see him. Give me 1 second.
Okay.
I think you're
Okay,
back,
sorry.
Tim.
I am back. I had a the electricity went off just for a moment. So I am back. I closed down the slides by accident, so I believe this is it. Nope, not it. Nope, that's not it. Okay, here we go. I heard some of those questions. Everyone hear me?
Yeah, yes, we can hear you now.
Okay. I heard some of those questions about Medicaid, so I'm going to come back to those because those are really important. The question I was answering was the 95% for the non-recourse feature. So let me start over on that, and then I'm going to jump into what you were talking about. So if a person has a $400,000 house and FHA says, statistically speaking, the home will increase at 4% a year. So $16,000 a year is what the house is supposed to increase by on average over the next couple of decades. So $16,000 a year for simple math, not doing the compounding because I can't do that in my head. 4% a year times 10 years, 4% a year on $400,000 is 16,000. 16,000 times 10 years is 160,000. So simple math, a $400,000 house in 10 years will be worth 560,000. Everyone with me? I hope so. Let's say that based on this person's age, that they were able to borrow $200,000. Again, I'm just using round math. So $200,000, let's say the interest rate is, heck, let's say 7%. So 7% on $200,000 is $14,000 in interest every year. The house is increasing at $16,000 a year. So that right there shows that on average, the math should be fine. But and but the house is growing at 4% a year on a $400,000 value, which means that the math is growing, the equity is actually growing. So in 10 years, the balance might be $340,000 of interest on a house that's worth $560,000. There's more equity in the house 10 years later than there was 10 years ago. So the math is always there. If there's a situation where this $400,000 house is still only worth $400,000. So here's where your question comes in. The balance on the reverse, now let's say, let me make it worse than that. Let's say the value of the house is only $300,000. But the amount that's owed on the house is $340,000. So the house is underwater by $40,000. In most cases, the kids will say, I don't want the house. Here's the keys. Goodbye. But what if they did want the house? Maybe one of the kids is still living there. Maybe they've never left the house. I've got a lot of customers with 60-year-old kids that have never left. Maybe the kids don't want to leave. They want the house. So to answer your question, FHA will give them a discount off of the current value of the house, not what's owed. But if the house is only worth $300,000, FHA will give the estate, the family, the buyer, the opportunity to get the house with a clear title for 95% of the current value. So in this example, it would be $285,000 on a house that's worth $300,000. They can get a clear title. And the thinking behind that is if there's no realtor involved, then FHA is saving money anyways, right? So why not pass that savings on to the person who's buying the house directly from HUD? And by the way, if there is a realtor involved, then the realtor still gets paid by FHA.
Okay.
Right.
So Tim, the next question, I think you just answered. It says, if the homeowner were to pass away with a balance, would the estate be responsible for paying off the mortgage?
Yeah, so yeah, I probably did answer the question. So with any mortgage, right? I want to defer back to with any mortgage, the estate has to be settled, or with any estate, the estate has to be settled. So the estate's going to look at whatever lien is against the estate. So in this case, a mortgage. The mortgage is lien against the house. The house is part of the estate. So the mortgage has to be paid off. So when things are being settled, if the house is worth $560,000 and the mortgage amounts is 340, then you got to figure out how to pay off that mortgage. Again, it could be a reverse, it could be a traditional mortgage, but the mortgage has to be paid off. And in most cases, the house will be sold, that debt will be paid, and then now there's a clear title.
Right. Okay. Let's see. Gloria wanted to know, does the bank have the insurance that is included up front onto the loan? Is that why
Yeah, I
they
know what that
eat the
means.
amount if the home value drops? So,
Yeah, so I understand that question. Let me expand on that question. So one of the first things I said on this loan was that some people think this is an expensive loan, and my argument point to that is this: that closing costs are financed into the loan, and the closing costs are more expensive than traditional financing. And the reason it's more expensive than traditional financing is the FHA charges an insurance fee to do this loan. The insurance fee is the not what makes the non-recourse feature kick in. So the non-recourse feature, it's called MIP. Now, most people in the world call it PMI, private mortgage insurance. This is MIP, which is mortgage protection, PMI, or MIP, mortgage um, protection, mortgage. Oh my gosh, I just had a brain fart. All right, MIP. It's like the opposite of PMI. It's what FHA charges to insure the loan. In case something bad happens, the lender fails, the house goes down in value, the loan balance exceeds the value of the house. FHA charges a one-time upfront fee of 2% of the appraised value. So if the house is worth $400,000, FHA charges an $8,000 fee one time that's added to the loan balance, so it doesn't come out of the person's pocket, to insure the loan. Then they charge an annual fee of a half a point, which is also added to the loan, so it doesn't. No one has to write a check for anything. So usually, when someone says, "Well, your closing costs are higher than what I can get at the local bank for a traditional mortgage," and the answer is, "Well, yeah, there's an FHA 2% fee that the local bank doesn't charge because they don't do HECMs. All HECMs have a 2% fee." So we're about 2% higher than any other closing cost. But a person doesn't have to stroke a check for it. It gets added to the loan balance, which means the house is going to pay that fee sometime in the future. And the benefits that it provides far outweighs the risk or the cost. Again, non-recourse feature kicks in. It protects the lender, it protects the estate, it protects the kids, it protects mom and dad. If the lender fails, FHA's got your back. If something bad happens, there's fraud going on when it comes to the lending or servicing process, FHA's got your back. That answer the question?
I believe so. And I know we probably need to go on. There's a question though about refi. So the original lender, is there a refi obligation to the original lender?
I don't understand the question.
So there's no refinance obligation to the original lender. So if you've got a mortgage on it and then you do the HECM mortgage, what happens to the first one?
Okay, I think I can explain that. If I don't answer your question, just ask it again. So here's what happens is FHA will only lend approximately, I'm just going to use the middle number, between 30 and 50%. FHA is going to lend approximately 40% of the home's value. So let's start off with a $400,000 house. FHA is going to lend 40% based on this person's age. 40% of 400,000 is $160,000. So if a person wants to do this kind of a loan and they owe $100,000 to Bank of America, and the FHA program will give them 160, the first thing we have to do is pay off the first lender. So that mortgage is extinguished. Now we have $60,000 coming from the HECM. If they owe $200,000 and all FHA is willing to lend, and I say that cautiously because they're not lending money, right? Banks lend money, FHA insures loans, but that's just how I say it. So if FHA is allowing for 160,000 to be lent, but the borrower owes $200,000, they either have to come to closing with $40,000 to make the numbers work, or they can't do the loan because any other liens against the property must be extinguished at the time of the reverse.
Okay, that
So
all makes sense to me. Does FHA sell to private individuals, also allowing the discount for clear title?
they do on a case by case basis. The first dibs are for the family, the estate, the family.
Okay,
But there is situations where somebody can step in and get that house for 95 cents on the dollar.
okay.
You know, it's not really an investment opportunity per se, not for a house flipper, because house flippers are looking for better deals than that. 5% immediate profit when most houses need rehab isn't going to cut it.
All right, why don't we go on with your slides then, if you would share your screen?
Oh, it's not shared?
Uh,
Okay, well,
I'm
let's fix
not
that.
seeing it. Are other people shake your heads? No? No, okay, nobody is seeing your screen right now.
Let me try this again. Okay, that's it.
There we go. Okay, we're good.
All right, so let's go back to what everyone was chattering about when I was offline. So I'm using the same example. Someone is eligible for $160,000. They owe a $100,000 mortgage. We're going to extinguish that mortgage, and now they have access to $60,000. They have a couple of ways of getting that money. They could take a lump sum. There's some rules with that, but they could take a lump sum. They could set up a line of credit, or they could take monthly installments. In other words, sort of like Social Security, just send me $500 a month until the money is gone. Or they can mix and match all the above. Now, this is where Medicaid and financial planning comes into play. If a person is on some kind of state assistance and they cannot have too much money in their bank account, then this is where the reverse, the HECM, comes into play perfectly. Because as most of us, if not everyone here, knows that homes are exempt, if homesteaded homes are exempt from being a accountable asset to the state, which means that the line of credit that's associated with this house is also not a accountable asset. And any proceeds received from a loan from the line of credit is not considered income. Okay. But whatever is left over at the end of the month becomes an asset. So hopefully I haven't lost anybody in that. Money at the end of the month becomes an asset, which means it cannot be in the bank account at the end of the month. It needs to be spent or sent somewhere, because money pulled from a line of credit is not income, it's a loan. Loans are not countable as income. So this is where a person who is on state assistance that does need money to fix the roof, to buy a car, to remodel, to pay for their medications, they can pull out whatever money they need from the line of credit and not be penalized for pulling out the money. And the asset is not countable. So this is perfect planning for guardians, financial planners, lawyers, and so on. All right, so for the HECM, which is the FHA version, the minimum age is 62. A 62-year-old could be married to anybody all the way down to age 18. We're going to base the loan amount on the youngest person's age. So if you think 30% of a home's value is not a lot of money for a 62-year-old who's needing money, imagine if they were married to an 18-year-old. The amount might be 10%. And the reason, of course, is because this is a lifetime loan for the last remaining spouse. An 18-year-old possibly has another 60 or even 70 years of life, and there's no required payments for life of the youngest borrower. So the requirement, once again, is they must be married. A 62-year-old must be married to, right? A 62-year-old with their very best friend who's 60, not married, does not qualify. The 62-year-old qualifies, but the 60-year-old is not married to the 62-year-old, so they would not be eligible for the loan. But if a 62-year-old was married to a 50-year-old, they would be. Now, when we run into people on occasion that aren't 62 yet, but need some kind of a reverse mortgage, and this is where the portfolio, the proprietary reverse mortgages come in. They will go down to age 55. They're not insured by the federal government, but the program is nearly identical. No required payments. It's going to be based on their age. So a 55-year-old is not going to be able to borrow as much as a 62-year-old or a 72 or an 82-year-old. But at least there's a program available for people as young as 55. And then there's hybrid reverse mortgages, which means that if somebody has a mortgage with a 2.5% interest rate that they don't want to give up, we can actually do a proprietary loan. We can actually not extinguish that mortgage and give them the reverse on the remaining difference. In other words, if I use that same $160,000 example, we could leave the $100,000 in place and do the reverse on the other $60,000. It would not be a HECM, but it'd be a proprietary, which is I would like to say equally as safe as the federal government program. If you look at the bottom of the screen, U.S. citizenship is not usually a requirement, but some kind of right to live in this country and a social security number or a tax ID number would be required. Okay, any questions? Okay, for properties, almost all properties are eligible, including manufactured homes. They have to be 1976 or newer. Condominiums are tough with FHA because of their rules, but if we can get the building approved, that's great. If not, we have the proprietary reverse mortgages. Duplex, triplex, quadplexes, I kid you not, fourplexes are allowed. Single family homes all day long, townhouses, villa, cluster homes, zero lot lines, modular, whatever you want to call them. In most cases, we're good. Where we run into problems is when someone has leased land. There's rules that usually kills the deal. And yeah, leased land. All right, moving on. All right, so what does it cost somebody to get into this loan? In most cases, just two things: the cost of the appraisal and the cost of counseling. Telephone counseling is a requirement for any kind of reverse mortgage. It's really to protect everyone, so people don't get taken advantage of. Everything else is rolled into the loan. If a person truly doesn't have the money to pay for anything, especially the appraisal, there's ways around that. The lender can pay for it and charge it at closing. And then the other fees are rolled into the loan would be the normal closing costs, doc stamps, intangible tax, recording fees, things like that. Most reverse mortgages have an origination fee. They don't have points, but they have an origination fee of upwards of $6,000. And other than that, it's the MIP, that 2% of the appraised value, which people think can be expensive. Now, here's the good news on the FHA is the property value can be worth as much as $1.1 million. If the property is worth more than that, we can still do a HECM, but we're going to cap the value as if the home is only worth $1.15 million, which means if a person can borrow 40% of $1.1 million, then they're borrowing $440,000. And in a lot of cases, that's plenty of money to pay off any mortgage and give a person cash back. If they live in a $3 or $4 million property, then a portfolio loan would make more sense. And maybe they can borrow on a $4 million property, maybe they can borrow $1.5 million. All right, questions?
There were a couple questions that looked like they were answered. The mobile you can do a HECM on a mobile home as long as the land is owned, right?
Correct.
Yeah. Is there a minimum FICO score?
On HECMs, there's no credit score requirement. There's minimum income requirements. We do pull credit to make sure that they have at least decent looking credit. And if there's glitches, then we ask questions. On proprietary reverses, there is a minimum credit score. It's 620, 670. It just depends on the lender.
And somebody wants to know what is the benefit to FHA for these mortgages? If you just go over that briefly.
Yeah, there's no benefit to the federal government. They're not looking to make a profit. They're enhancing the opportunity for people to have mortgages. You know, ever since FHA was founded in the 40s, the goal of the federal government being involved in mortgages is to allow more people to become homeowners. So FHA came out with this program not to make money, but to insure lenders so lenders are comfortable lending money so more seniors can age in place.
Okay, I think we can go on. We've got about 10 minutes left.
Yeah, I'm going to go this relatively fast, but when someone truly understands the HECM in particular, it's a it's a super great financial planning tool. CFPs truly love reverse mortgages, in particular HECMs, because they're so safe and it provides a bucket of money that would normally not be available. Think about this: if your house is worth $500,000 and it's paid for, and you're living paycheck to paycheck, or you had a limited amount of assets in the bank, or maybe you have a lot of money in the bank, but it's tied up in investments, in stocks and bonds and in land. But you have $500,000, a bucket of money that you can't touch unless you get a mortgage. And most mortgages have a monthly payment. Now we have a program where you can get a mortgage, in this case a reverse, and not have a required monthly payment. In fact, a lot of estates are actually enhanced, if not increased in value, but at least enhanced because there's more cash flow. You're saving on property on capital gains taxes, on real estate, or I'm sorry, getting tongue tied. You're saving on income taxes. There's all sorts of ways to use a bucket of money, a non-taxable source of funds, in ways that will actually increase your estate and reduce your taxes. So you can delay Social Security by using money from a HECM that's tax free until your uh, full retirement age, which is now 67. You can, again, use it as a bucket of money. If there's another housing crisis, this might actually offset any losses. I'm going through this fast. The current lending limit is 1.149 825, 1,149,825,000. The other slide says 75. That's wrong. That's the lending limit. So for an age 75-year-old, if you look at the very bottom of the screen, a 75-year-old could get $431,000 based on this home's appraised value. That would be completely tax-free money. So what are these loans good for? Why do a reverse? Well, it's all about cash, right? It's about disposable cash. I've had people give kids money now in advance, basically establishing their legacy in advance of their death versus making it, death money. Of course, healthcare, long-term care, a newer car, pay off debts. My gosh, credit card debts are outrageous, averaging 22% right now. Remodel a home, make it handicap accessible, go have fun, take vacations. We had a client that took a round the world cruise. That was their goal, and they did it. They could afford it. Helping their grandkids through college, helping our seniors, and mainly because you care. All right. Questions?
All right, Tim, that was great. I mean, I know that, a lot of us on this call deal with people that are trying to pay for care. And, paying for care in the home, what a great way to free up some money to pay for care in the home. Something like this could provide. There was a question about any books on this that you might recommend. Sean had said maybe something written by Dr. Wade Foe.
Yeah, foul. No, he's more about, well, his books are awesome, of course. I tell you, there's the best book in the industry. It talks about the program more. So Dr. Fow is more of a retirement income specialist. And he's a PhD and he's well respected in our industry. And his is more about long-term planning and maximizing retirement income and reducing taxes, which is fantastic for people that are going to be planning in advance, 50, 60-year-olds. Usually when we get to someone that is needing estate planning or guardianship, it's usually too late for Dr. Fowl. Where this other book from, oh my gosh, you probably go to Amazon and get it. Um, let me see, let me type in Amazon real quick. I can't remember the name of it, but he publishes a book every single year. It's the same book, just updated.
I'm looking through the questions to see if there's any more that we might have missed. If you still have a question, we have about 5 minutes left. Go ahead and type it into the chat.
So the name of the book that I would recommend, if you go to Amazon and type in reverse mortgage, you'll come up with the top two. One is Dr. Fowle's book on retirement income planning, and the other one would be the one that I would recommend. If you really want to read a book, would be called Understanding Reverse, Simplifying the Reverse Mortgage. Understanding Reverse, Simplifying the Reverse Mortgage. The author's name is a friend of mine. If you want to write this down, it's Dan. Last name is Hurlquist, which is HULTQUIST. Dan Hurlquist.
I think I got
Paperback
that
is
right into the
$3.
chat. Understanding Reverse, Simplifying Reverse Mortgage by Dan Holquist.
Hurlquist, correct. Yep.
Okay, great. So I'm not seeing any other questions. Tim, do
So
you
let me
have
close.
some final words for
Yeah.
us?
So let me just close with this. As you know, a mortgage is a mortgage is a mortgage. We all know how mortgages work, and this is the safest loan in America. We do not have a debt to income ratio, do not have a credit score requirement. HECMs don't. We have minimum income requirements, and the income is really just, can you afford to live in the house that you're living? Can you pay your taxes, your homeowner's insurance? Do you have enough income to afford to live there? We don't have a debt to income ratio. We do look at credit reports to see what the expenses are, such as a car payment, a house payment. We look at certain things, and we look at how those payments are made. If there's glitches, then we look for reasons. In other words, I've had some health issues, that's why I missed a car payment. I had some health issues, that's why I missed the last two mortgage payments. And the underwriter will take that in consideration whether to approve the loan or not. Pretty much all loans are approved, and if they're not approved without any conditions, the condition might be that we set money aside in an escrow to pay future taxes and insurance. So usually loans are approved. I would not hesitate to at least inquire about a HECM. Remember, it's a mortgage with optional payments. That's it.
Right. Yeah, that's the basics. Great. Oh, well, thank you so much, Tim. This was really great. And Tim is a good resource, so don't hesitate to reach out to him in the future. I wanted to just say a few words. Our next webinar on March 13th is going to be provided by the Area Agency on Aging. And they are going to talk about resources available to our seniors and some persons with disabilities throughout the state of Florida. So I think the AAAs have lots more programs than many of us are aware of. So I hope that you will find the March presentation very informative and helpful to the population that you serve. Please be on the lookout for an email from Kate at trustaged.org within the next week with your certificate of attendance. And thank you once again, and happy Valentine's Day to everyone. Bye-bye.